my research on the index versus active question. So the index versus active question is, when does indexing beat active management and when doesn't? And hence the title of this, when indexing works and when it doesn't in U.S. equities, the purity hypothesis. Now, the main point of this presentation is to say that the conventional wisdom on this topic is wrong. And there's an alternative view called the purity hypothesis that does a much better job of explaining when indexing wins and when active management wins. So let's start with the conventional wisdom. The conventional wisdom says that the main factor determining when index funds beat active management funds, actively managed funds, is the efficiency of the market that the active funds operate in. Active managers are more likely to win in small stocks because these are less efficiently priced. And index funds are more likely to win in large stocks because they're more efficiently priced. Now, this is all just jargon, blah, 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 from investment managers. Stock price efficiency, all that means is how close a stock's price is to its true value. The prices of small stocks are farther away from their true value because there's not very many people and Wall Street analysts following these stocks, so they're priced less efficiently. Therefore, there's more opportunity for an active manager in the small cap space to buy a small stock below its true value and sell it above its true value. And it's the opposite in large stocks because there's a lot of people following large stocks, a lot of Wall Street analysts. We all follow a lot of, at least a number of large cap stocks, maybe Apple and Google. Because there's so much minds and money following the price of large stocks, there's less opportunity for a large cap active manager to buy one of these stocks below their true value and then sell it above its true value. That's the conventional wisdom. Now, this sounds logical, but the truth is there's very little evidence to support this. However, there's lots of evidence to support what I call the purity hypothesis. The purity hypothesis says that the main factor determining when indexing wins and when it doesn't is the purity, the style purity of active managers. So style purity, there's another jargon there's more jargon from the investment management industry. Style purity simply means how closely an active manager sticks to its style category. And we'll get to that in a minute. So let me be clear, the purity hypothesis says this. In the top performing US equity asset classes, that's where indexing has a much better chance of beating active management. And in the worst performing US equity asset classes, that's where active management has a much better chance of beating indexes. So we'll get to that right now. But before we do, I just want to say that I am not the person who came up with the purity hypothesis. Bill Bernstein figured this out in the late 90s. He published a few little things about it. Not many people read it, but I did. And so in 2007, I contacted Bill Bernstein and I said, how did you get the data to show the purity hypothesis works? And he told me, he's a great guy. And so he stopped writing about it and he says, you go for it, you write about it. So I did start writing about it. So my first article was in the Journal of Investing in 2009. Now, the Wall Street Journal loved this idea. And so later that year, November 2nd, 2009, they wrote a pretty big article on the purity hypothesis. They interviewed me and they interviewed Bill Bernstein. Later in 2012, I updated the purity hypothesis data for the Journal of Index Investing, and my latest one forthcoming will be also published in the Journal of Index Investing later this winter. So let me tell you how the purity hypothesis works. I'd like you to imagine the U.S. equity market in this way. The U.S. equity market can be made up of 9 style boxes. The large stocks are there on the top from left to right, then there's mid-sized stocks and there's small stocks. And then down the vertical side on the left, there's value stocks, core and growth. The value stocks, these stocks have prices that are low relative to their earnings. So the classic value stock today are coal mining stocks. They're getting crushed, so their prices are low versus their earnings. Core stocks are kind of in the middle. And growth stocks have prices that are high relative to their earnings. These would be tech stocks, for example, like Apple. These are the glamour stocks. So remember, the purity hypothesis says that in the boxes that have the best performance relative to all the others, that's where indexing wins. And the purity hypothesis also says that in the boxes that have the worst performance relative to the others, that's where active management wins. So in this example, this is just an example. In this example, large cap growth stocks have the best performance. So it's written right there. So since they have the best performance, that's where indexing wins. And small cap value stocks have the worst performance, so that's where we're saying active management wins. The question's why? Why is this? And the answer to this question is right at the bottom of the slide. The answer is that active managers are not style pure. Active managers often invest outside their style box, and this is the key to understanding why this works. So let's go to large cap growth. Say that you're a large cap growth active manager. Most large cap growth active managers are not true to their style. If you're a large cap growth active manager, many of the stocks you buy are going to be in this box, but you'll have a whole lot of stocks out here. And so if large cap growth is the best performing asset class, and you've got, say the large cap growth index returned 20%, and these boxes out here return 15. Well, if you've got holdings out here in the 15, but your index returned 20, that's going to pull down your return versus the index. So that's why the index does better versus active management in the best performing asset class. And it's the opposite in the worst performing asset class. Let's just say small value is the worst performing asset class, and say that small value stocks return 5% and everything out here returned 15 again. And if you're a small value active manager, most of your portfolio returned about 5%, but if you've got holdings out here in the 15%, that's going to move your returns up versus the index, so you're going to beat your index out here. And that's really all there is to it. It's simply a matter of style purity. So what we get is that in the worst performing asset classes, active managers are rewarded for their style impurity, because they've got stuff out here in the better performing asset classes that buoys their returns versus the index. And in the best performing asset class, active managers are punished for their style impurity. Because if this asset class returns 20 and you've got holdings out here that are down at the 15 mark, that's going to lower your returns versus the index, and therefore make your active management returns go down versus the index. Therefore, the index wins here, active management wins here. Active managers punished for their style impurity, active managers rewarded for their style impurity. Yeah.
Would that hold if the best performing style category was flipped?
Yes. Doesn't matter. Doesn't matter where those boxes are. This is just an example, and you'll see when we get to the real data, boxes are in different places. The green and red is in different places. So you're right. Down here it looks like, well, Bill, you're saying small cap is where active management wins, and that's congruent with conventional wisdom. Yeah, but only because this is an example. Now let's get to the real data. So what you're looking at is evidence for the purity hypothesis. So what we're looking at is an analysis that index versus active performance analysis. What we've got, remember those 9 style boxes. So the 9 style boxes are here represented by the Russell Domestic Equity Indexes, ranked by performance against their corresponding active managers for the 15 years into 2017. So the 9 style boxes are right here. The best performing box for the 15 years into 2017 was the Russell Mid-Cap Core Index. Its performance was 12.1%. It was the top ranked index. The percentage of active managers that beat that index in the Russell Mid-Cap box was 7%, very small. MC means mid-cap core, we'll get to that in a second. The second best performing index was Russell Mid-Cap Value. The percentage of active managers that beat that index was 9. The third best performing index was the Russell Midcap Growth. Percentage of active managers to beat the index was 20. And I hope you see a pattern here. The pattern here is that the lower this number gets, the larger this number gets, the lower the rank, the bigger this number gets. Meaning, the better the performance of this index, the worse active managers do, and the better indexing does. When you get down to the bottom here, the worst performing index was Russell Top 200 Value, that's large value. Worst performing index. And yet, the percentage of active managers that beat the index was 66%. So in the worst performing index, worst performing style category, active managers did their best. In the best performing index, Russell Midcap, active managers did the worst, and it's almost a one-to-one, not always, but it was, in this case, almost a one-to-one correspondence. Top performing asset class, that's where indexing did the best and active management did the worst. Second performing asset class at 9, you just go 1 is 7, 2 is 9, 3 is 20, 4 is 29. As this number gets larger, this number gets larger. So there's a very tight correlation between index performance rank and percentage of active managers that beat their index. The higher the index performance rank, the lower the percentage of active managers that win. The lower the index performance rank, the higher the percentage of active managers that win. Now there's a way to measure the strength of this correlation. It's, you remember stats 100 or 101. It's called Spearman's rank correlation coefficient. Get to that right now. Just ignore this part for a second. We're only talking about this right here. If Spearman's rank correlation coefficient is greater than 0.6 for all of this, I'll spare you all the stats. You can do a statistical examination of this. If Spearman's rank correlation coefficient is greater than 0.6, then there is indeed a very tight and strong correlation between index performance rank and percentage of active managers that beat their index. For this, it's 0.94. So all that means is if this number is above 0.6, what that means is there's very strong evidence that indexing wins in the top performing asset classes, and active management is much more likely to win in the worst performing asset classes. I want to show you a picture of that right here. What we've done is we've ranked each index by its performance. So the top performing index is MC, which is Russell Midcap. Then we take the second one, which is Russell Midcap Value, the third one, Russell Midcap Growth, and so on. That's the horizontal axis. The vertical axis is the percentage of active managers that beat their index. 0%, 10%, 20% that beat their index. So all we're doing here is putting this on the horizontal axis and percentage of active managers beat their index on the vertical axis. And as you see, there's just this, it's not a straight line in the data, but it's almost a straight line. As index performance rank goes down, the percentage of active managers that beat their index go up. So if we graphed these things and they were just a big cloud all over the place and didn't line up in a line, there'd be no relationship. But when they line up in a line like this, you're starting to see something that makes some sense. That is why Spearman's rank correlation coefficient is so high at 0.94. And that's why, if you're a statistician, you can be confident in saying, hey, there's something going on here. There's a very strong relationship here. Indexing seems to win in the top performing asset classes, and it's active management seems to win in the worst performing asset classes. So this is the reality. For that 15-year period, the best performing asset class was mid-cap value. And the purity hypothesis would say that indexing wins in the mid-cap in the mid-cap core space. And it wins because mid-cap core active managers invested some stocks outside their style box. Remember, this is the top performing box, and if you've got holdings outside that are lower in return, that's gonna reduce your active management returns versus the mid-core index. Therefore, indexing is more likely to win here. And it's just the opposite story here. Remember, large value was the worst performing index. So why is it that active management won here? Well, it's because large value active managers invested in some stocks outside their style box. They were investing in stuff out here that had lower returns, and those lower returns outside the box tended to drag down. Sorry, messed it up. It's the opposite, right? So these guys here invested in stuff outside the box, and that tended to lift up their returns versus the other. So that's why I think, and many others think, that this purity hypothesis is a better way of looking at index versus active performance than just the conventional wisdom. So the thing with any academic, this is kind of academic-y stuff. The criticism of academic-y stuff like this is, how do I use this in the real world? Well, there's 4 ways I think to use this in the real world. I'll tell you, I definitely use it in these 2 ways, but let's just look at the first one. If you have a view on which one of those boxes is gonna do better, we don't know if it's gonna do better, but if you have a view, you should index that box. Because if you do, the purity hypothesis tailwind will be in your favor, and it'll be tougher for an active manager to win in the best performing one of those boxes. Conversely, if you have a view on one of those boxes and you think it's going to be the worst performing box, well, go active in that box, because an active manager will have a purity hypothesis tailwind for itself there in the worst performing category. Now, I have to tell you, my boss, I was working at Hammond Associates, and he looked at this and he said, Bill, what's the good of this? You're saying that in the asset classes that everybody wants to be in, that's where indexing wins. And in the asset classes that no one wants to be in, that's where active management wins. And I said, yep, that's what I'm telling you. And he was a pro-index person, and so he liked that. So if you like indexing, this is good news, but if you like active management, maybe it's not so good news. Now let me tell you the 3 and 4, how I use this every day. I'm in charge of the public equity portion of the portfolio. So all kinds of public equity active managers want to talk to me. And they'll come to me and say, look at my active management outperformance in one of these boxes. And I'll go and I'll say, well, in some of those boxes, these managers may be worth a second look. So if there's an outperforming active manager in the best performing US style categories, I may give them a second look. Because we know that in the top performing categories, percentage of active managers that beat their index in the top category, only 7%. Maybe one of these managers, or a couple of them, are actually doing pretty well. They're not, and they deserve a second look. These guys are bucking a purity hypothesis headwind. But, active managers, they come to me in the worst performing US equity style categories and they say, look at my outperformance that I am giving you, or that I have brought to the market. If they are in the worst performing style categories, I don't know if they deserve to stay, because they've got a purity hypothesis tailwind behind them. So we know in the market today, value has greatly underperformed growth. Value stocks have underperformed growth for many, many years now. And when value active managers come in to talk to me, I'm not that impressed, because they all, let's just take one example, especially in large cap value. The worst performing asset classes over the last 15 years was Russell top 200 value. When large cap value active managers come to me and say, look, I've outperformed for all these many years, I say, yeah, well, 2/3 of your active management colleagues also did. I'm not that impressed. So this is how you use the purity hypothesis in numbers 3 and 4. It's a tool to kind of sort out who's better and who's not. At least it's a kind of a tool. And then for looking forward, index the US category you think will outperform, you'll have a purity hypothesis tailwind. Go active in the US equity category you think will underperform, you'll also have a purity hypothesis tailwind. So let me just stop right there. Thank you for your attention. Are there any questions?
So, Bill, you're not discounting the conventional wisdom that you talked about before. In other words, that 7% that you pointed to, that was basically facing a headwind or whatever in order to achieve that result. There must be some factor that goes into that.
You would think they're doing something right.
Right, I mean, so.
You would think they're doing something right,
So
but
maybe
there's not many of them.
maybe their research and analysis is really spectacular. What's your thoughts about that? Because there's something that's affecting their ability to do that.
Well, I think it's, in my view, I'm biased, I think it's simply their style. You know, in the top performing asset class, an active manager's just gonna have a tougher row to hoe. And that's why there's so few.
But they still outperform.
Some of them did. Now, I'm less interested in the ones that outperform just because they took more risk in the mid-cap
Right.
core index. If they're just taking more risk, then I'm not interested, because anybody can be lucky and take more risk in the top performing asset class and outperform it. I don't care about that.
So
But
you
if
would
they
do
are-
you would do an analysis of how far they've drifted from their
Yeah,
style, right?
yeah, and I wanna see, are they actually beating the index because they're simply taking more risk? Or are they actually beating it because of their stock picking ability? That'd be what I hone in on. Yeah.
Bill, and you clearly have proved your point well looking back. But your point about index the category you think will outperform, and that's the rub.
There's the rub. There's the rub. No one knows.
Yeah.
But a lot of people have a view. I mean, you know who really likes the style, this purity hypothesis? Are the guys, they're called ETF managers, and they use a bundle of ETFs in any of the 9 style boxes to outperform. And so they'll switch among the different boxes using only exchange traded funds to try to get good returns. And so I've talked to them about this. They love this because it justifies their use of only ETFs, because they're trying to be in the box that's the top performer. And so when I say, oh yeah, if you're trying to get in the box that's the top performer, you should use just index funds or exchange traded funds. They're like, yeah, that's what I do. And I said, yep, that's what you should do, at least in my view. That's what the data shows.
More? Come on now. So what's your hypothesis? Do you think our system can get 7.4% indexing?
No. I think that the 30-year returns for just equities that NEPC uses, I think for equities they are around 7. But can we really have 100% of our